Well, good morning, everybody. We continue with our In the Trenches series today, where we are specifically talking about some of the recent changes to the Paycheck Protection Program loan programs. We're going to be looking really at two things today. One is regulatory developments for lenders that are at the top of the agenda, as well as forgiveness issues that have developed over the last few weeks as we got some revisions to the forgiveness protocols, as well as how forgiveness is going to be processed. And so really we're going to look at it as we do oftentimes with PPP programs, where we're going to have some discussions focusing on the borrowers, and we're going to focus on the lenders and talk about how this is developed. So with that, we'll kick things off. As we talk about forgiveness, just remember kind of the basic timeline associated with the Paycheck Protection Program. Perhaps most important for today's discussion, there have been extensions now granted for the Paycheck Protection Program. The deadline is now August 8th, 2020. There are some rumblings that may potentially be extended to the end of the year, as was the original proposals in the congressional bills. August 8th has been kind of the compromise position that has been articulated. But obviously, we've already started seeing the forgiveness process. We've been working with a lot of our banks, as well as credit unions, lenders, and technology providers on their forgiveness platforms. We'll talk about this in a second, but interestingly, not many people have processed forgiveness applications yet. But it's steadily increasing as more and more people become eligible. Obviously, the earliest anyone could have become eligible for forgiveness would have been the end of May, beginning of June, and that would have assumed that you were using the 8-week forgiveness period and you had obtained your PPP in round one and had already applied for forgiveness. Candidly, a lot of lenders do not yet have their forgiveness portal fully up and running. They're still developing it. And part of that is, as recently as 2 weeks ago, there were changes to the forgiveness process. So a lot of lenders still very hesitant to put significant infrastructure in place and really start running through PPP forgiveness applications because of these concerns over these ongoing changes as SBA and Treasury continue to dial in the PPP process. Some interesting data has started to develop regarding the PPP program. We still have just under 5 million loans that have been made to date. Interestingly, about 521 billion has been approved. That still leaves a significant pot of money that's still available. So there's a lot of outreach going on right now to try to pick up folks who may have been scared out of PPP with some of the changes that occurred early on, as well as really trying to target outreach to communities that may have been underserved or not confident about their ability to obtain a PPP loan because of some of the restrictions certain lenders put in place regarding existing customer relationships. Numbers continue to skew towards the smaller side. 86.6% of PPP loans by total volume, meaning number of loans, were for less than $150,000. We'll talk a little bit about that as we go through. $150,000 has started to become the magic crossover point in PPP. We'll talk about the impact it's having on disclosures, as well as some potential future changes that may make it even easier to have sub $150,000 loans forgiven. Interestingly, when we look, 95% roughly of loans are for less than $350,000. So again, mainly focused on the small and medium business enterprises. In the U.S., numbers tend to yield out very similar to what was projected. So it appears that the distribution is working fairly accurately. Some interesting facts for lenders. If you look at number of loans by lender size, it's almost 50-50 between the giant lenders above 50 billion and those below 50 billion. Similarly, value of loans, interestingly, the small loans by small lenders are eating up about 2/3 of the pie. So, fairly good distribution across the size of the institution that is making the PPP loans. So that data has been very promising, particularly for smaller lenders. This next one we thought was fairly interesting. If you actually look at the number of loans, the dark blue line here, it tends to model out fairly evenly across the size of the lender. Small lenders, so community development, financial institutions, smaller credit unions, banks, actually making by volume very similar number of loans to the giant institutions. Where you see the difference, obviously, is the loans that the giant institutions are making, which is the far right column. Slightly more in number, but significantly larger in average loan size. One really neat data point that SBA has been publishing recently is the number of jobs that have been saved through PPP. That's that light blue line, and you see, you know, in essence, millions of jobs have been saved and paid for via the PPP process. So as we talk about whether you're a lender or a borrower, how to contain or describe your use of the PPP money, remember it's all about jobs, and the data is proving that out. One other interesting fact, this is by industry code. What we've seen is healthcare, lawyers, and CPAs made a lot of use of PPP loans. These are all of the PPP industry categories that are being tracked by the SBA, broken out. The light blue columns are the net dollars, so you see it's ranked by net dollars, and then the two lines show average loan size and loan count. And yeah, as you see, manufacturing, anything that's heavy industry tends to be fairly large average loan sizes, but lower loan counts. But interestingly, as you look through construction, getting a huge boost out of this, what many people found interesting looking at this data is accommodation and food service and retail trade, not the most highly represented industry groups here. Yeah, when you actually go through and look at the net dollars that were received, the loan count is fairly high for those groups, but not much being used. So that could be a reflection of the fact that for many of those particular industry groups, you didn't have significant retention of employees. Instead, the money tended to be used for more ongoing expenses. So if you're one of these people who likes to look at future trends and what potentially this data shows about the U.S. economy, here you go. Feel free to take a look at this. Obviously, all these slides will be made available after the presentation. It'll be archived on our In the Trenches series website as well. One thing I will note, if you do have questions as we go through today, feel free to send those in the question box. We're happy to try to take those in real time and respond to them. Both Craig and I are happy to kind of monitor that and try to respond to you as we go through this presentation. You know, again, more for lenders, great data here that's been generated by the SBA as of last week. These are the percentage of small business payrolls that have been saved by PPP. And when you look at particularly Florida, upper Midwest, the Mountain West, you see huge percentages of small businesses were being supported through the PPP program. And almost every state is somewhere in the 80s or 90s. The lowest is 72%. Of small businesses supported by the PPP program. You go as high as Florida with 96%. But really interesting data that was generated here showing that PPP is truly working to maintain small business payroll. I mean, this is truly payroll numbers compared to PPP loans and the percentage that's being saved. So if anyone is questioning you as a borrower or questioning you as a lender about why you were either obtaining PPP loans or making PPP loans, here is the data for it. It's saving people's jobs across the U.S., and this is the data that backs that up. Interesting, one thing we've seen a lot of recently are questions about disparate disbursement of PPP funds, meaning are underrepresented groups being disproportionately left out of the PPP program. Latest data shows that 27% of PPP funds went to LMI, or low to moderate income census tracts, which is one way that lenders tend to track their performance in serving underserved communities. And about 28% of the population lives in LMI census tracts, and 27% of PPP funds were sent to those LMI census tracts. So far, when we look in the aggregate, granted some states have more of a disparity. When we look at a nationwide aggregate, fairly good distribution of the funds across the U.S. so that most states are tending to model out the same. Let's talk a little bit about what's changed in the last few weeks, some of the borrower concerns that have developed, and yeah, we'll actually start cutting through those now. Perhaps the biggest thing that's making all the headlines over the last 2 days is on July 6th, Treasury posted a searchable database of all recipients of PPP loans of more than $150,000. You can actually go to SBA and take a look, and you can, Control F and search for anyone you want to. And it actually provides loan level data, who the borrowing entity was, name, address, geography, number of jobs they certified, total payroll that they certified, as well as the data is collected, the gender, race, ethnicity, and veteran status of those particular borrowers. We just, for grins, cut here the Georgia and Chicago largest takers within the legal sector, and you can see a little bit about what the data is that's being provided. It will not disclose the actual dollar figure. Instead, it codes it by range. So A is 5 to 10 million, B is 2 to 5 million, and so it tends to section it in the same way that SBA is modeling and reporting that data. Actually, one thing there, and Craig, jump in here if you want. We've seen a lot of pushback in the last few days to this. Obviously, many media outlets, news sites are going through, they're looking at this data, trying to find the, quote, bad actors who obtained these PPP loans. Also remember, because of how this data is generated, you can search it by lender, and you can start to, very similarly to how you can search a HMDA, the Home Mortgage Disclosure Act database, or search other lending databases, and you can actually look at bank, credit union, or lender level performance. So just be prepared that if you are a lender, you may be getting some questions as well.
Yeah, I look at that as concerning, just in the same way as I look at the CFPB complaint portal or the HMDA LAR data that's available publicly. Inevitably, we're going to start to see plaintiffs' attorneys leverage this tool, as well as regulators to leverage this tool once they have access to peer data that's out there publicly. It can be parsed and tested and used against you. So I think it would behoove everybody to start to try to sort who their peers are, who they're closely aligned to during their regulatory exams, just to start to kind of look at that data and see if you have any issues.
Yeah. And somebody wrote in with a question I want to make sure we pick up, which is, as a lender, should you be encouraging borrowers right now to start processing forgiveness application? A lot of that's going to be responsive to what your customer base is demanding. I think any lender right now who's not planning or has already put in place how they're going to process forgiveness applications is probably behind the ball. You really need to be on top of this, whether it's one of the third-party vendors that are currently in the marketplace. I think there's almost a dozen who will help you with processing these forgiveness applications, or if you're going to handle it in-house. We're seeing more and more interest from borrowers who going in and saying, we want to start applying for forgiveness, particularly those that were operating under the 8-week protocol, meaning the 8-week forgiveness period where they burned all of their money already. They're ready to process forgiveness and be done with it. We've seen a lot of interest from borrowers. So I think, yes, you need to be reaching out to borrowers and explaining to them how you're going to process forgiveness applications, because the borrowers are getting anxious, if you will, and ready to go. One interesting thing is the SBA has not released the number of borrowers who have applied for forgiveness. One of the things we've done is we've gone into the data sets that got released 2 days ago, and we've looked and said, okay, out of the entire data pool, how many of those loans currently have demographic data available? And if you look, of the total number of loans, 29% have a reported gender of the owners of the company, 21% have veteran status, 14% have race ethnicity. Some of that could have been reported by the lender. But if you think about where that data is largely coming from, it's the forgiveness applications. So the final page of the forgiveness application, as we'll cover in a second, asks about the race, ethnicity, gender, and veteran-owned status of the company. And so if we kind of extrapolate those two together, as well as what we're hearing from our own clients, the number of people who are applying for forgiveness so far is very, very small, and likely below 20% based on these data sets that are available. Probably even lower than that based on what we're hearing, although it's picking up a little bit every day. As an aside, as a lender, one thing to consider is if you are looking at working with a third-party technology vendor, obviously be very cognizant of your third-party vendor management process. Make sure you're vetting that company well. But similarly, just understand the prices have gotten very competitive for that. And so if you're thinking about whether you want to do it in-house or outsource it, there are companies right now, almost all of them will do it for less than $100 a loan, many for kind of, somewhere between $30 and $60, $70 per loan. So if you're considering whether you want to help outsource, have a portion of your application process outsourced, just understand you can get those types of pricing that may free up some of your employees to work with those special case borrowers who have custom needs associated with it. Last slide I'll share is if we look at some of the demographic data, again, looking at who received PPP loans and how it compares to the general U.S. population. Surprisingly, compared to if you had listened to the Senate and House testimony with Chair Powell and Secretary of Treasury Mnuchin 2 weeks ago and 1 week ago, respectively, there were a lot of questions about how PPP funds were being deployed. And admittedly, there are some issues with comparing the number of loans to certain protected classes compared to their representation within the U.S. Census Bureau's annual business survey. But one thing to be aware of is you actually tend to see fairly similar percentages in modeling coming out, although there are a few standouts that are particularly underrepresented compared to the U.S. Census data. But nonetheless, you do see some significant outreach to traditionally underserved communities or protected classes. And so again, as we think about potential risks to a lender, for fair lending and what have you, just understand that now with this database out there, you can start to reconstruct your peer groups and understand exactly how these percentages break out. And if you have significant deviance from these baseline numbers, it may be something to consider. Many borrowers continue to ask, okay, when can a borrower submit a forgiveness application? Originally, it was 8 weeks. Then it was extended, obviously, to 24 weeks, extending the time period in which you could use your PPP loans. The new rule is you can apply anytime within the applicable period. So, if you fully burn up your PPP funds 18 weeks into the 24-week period, and you were eligible for the 24-week period, you can go ahead and submit your PPP application. And so in that regard, you can submit it at any time. Just understand you can't project expenses going forward. So if you have not yet exhausted all your PPP funds and you still have some period left in your 24-week forgiveness period, just understand that you may want to continue to hold out so that you go through and fully exhaust all of your funds. Many borrowers ask, okay, well, what happens if I don't apply for forgiveness? Or when will the lender start charging me interest and making me make payments under my PPP? The start date under the revised PPP Flexibility Act is now 10 months after the last day of your covered period. So what that means is you take the day of disbursement, you add 24 weeks to that, and then 10 months later, interest can start to accrue and payments can start. So you actually, as a borrower, have not only your 24-week forgiveness period, but you've also got 10 months tagged on after that before you have to begin paying the principal and interest that's due under your PPP note. Yeah, still lots of borrowers calling into us. We're advising a lot of clients on this necessity issue. Any of you who are following PPP know that there was this constant back and forth over, companies that were getting PPP loans and the certification that was contained inside of the borrower application. And what the SBA eventually did as kind of a compromise position is they said, we are going to give something of a safe harbor to people who have less than a $2 million PPP loan. And so if your total PPP together with your affiliates was less than $2 million, then they will presume that your PPP loan was necessary and that you would have made that certification in good faith. Okay, fair enough. Nice benefit for those obtaining less than $2 million PPPs. Anything above $2 million, still subject to the certification process. There is not that presumption of necessity for those above. But the caveat to this is SBA has been consistently walking this back in guidance. And so what you'll see is, like, for instance, in the bottom right of this slide, we note that, the SBA in reviewing the loan can still determine that there was a lack of adequate basis for a certification. It potentially could be a certification violation, meaning they will presume you had necessity, but if for some reason something shows up that leads them to believe you made it in bad faith, they potentially have the ability to go back and review applications for sub $2 million loans. As the SBA has previously noted, all loans in excess of $2 million are getting audited. Those under $2 million will only be audited, quote, as appropriate following the forgiveness application. Big thing to remember here is, it's kind of like being audited by the IRS. You don't know until it happens. A very significant change for those receiving PPP loans of less than $2 million. A lot of protections granted there, but that is not, in essence, a get out of jail free card or something that invites you to defraud. One of the things that we've seen, and this was in the June 22nd updates that were released, is the SBA can similarly go back and determine that the loan is not eligible for forgiveness if the borrower violated the terms of the PPP loan application. They specifically say, for example, because you lacked an adequate basis for the certifications as you made that application. So with that being said, the SBA continues to kind of claw back a little bit of their ability to go after what are seen as the worst actors. And, Craig, we were talking before we got on the presentation today about kind of how you see this playing out in the next 6 to 12 months.
Yeah, I'm just, as you say, they're starting to walk back the language or the narrative of anybody below $2 million will not be a focus of the SBA or Treasury. I believe that you're starting to see, like, the language that you've highlighted here being put back in the IFRs or any kind of official guidance that's being released, because they're starting to see, and we'll talk a little bit more about this later in the deck, but a shift in the reputation of the PPP program and how the funds were being used. And I believe the SBA and the Treasury don't want to see themselves having to defend the fact that they were giving anybody under $2 million license or a get out of jail free card for any inconsistencies in the application of the processing of the loans. I do believe you might start to see that kind of dissipate, or then walk it back even further. The more news stories you see, and the more in the news cycle you see that the focus is on who got these loans, what the banks are doing with the fees. It's going to drive a shift in the regulatory focus and possibly examination by the SBA and the Treasury as to who they can point the finger towards possibly inconsistencies in the application or just straight out fraud.
Yeah, one question that was sent in that's worth noting is what happens if you submit your application prior to the expiration of the 24-week period. In essence, it freezes that point in time. So when you're talking about eligible expenses and what was spent on eligible expenses, it's up to the point you submit the forgiveness application. So if you fully burned through the money during that time, subject to the per week caps that we'll talk about in a moment, it may make sense to submit it early, particularly if you had expenses that, you know, take up the 40% that are eligible for non-payroll expenses. Then it may make sense to submit early. But when you do, one of the things the interim final rules have made clear is, in essence, locks a point in time, and you can't then, in essence, go back and re-supplement it as you go forward. A few just pointers. As I say, all of these are archived on our website. But, you know, as a borrower, make sure you're still keeping very good records of the financial condition of your business at the time you applied. Make sure you're documenting it, just so that should these questions come up, you've got defensible documented evidence of the impact of coronavirus on your particular business. As I say, it's one of those where we hope that borrowers are not going to be subjected to extremely detailed audits of their records. But even if you got sub $2 million PPP loan, don't automatically assume that, you know, we drew the monopoly card that says get out of jail free, and there's no likelihood the SBA or your lender ever questions anything. In fact, you know, potentially, as Craig just noted, there may be, as tides shift, additional look back that occurs. So make sure you're keeping all this documentation. Should you ever need it, hopefully you don't ever need it. Obviously, as everybody knows probably who's on the call today, the original PPP loan forgiveness application originally got released on May 15th. It was released, nobody did anything with it. You know, lenders had heard that in a shortened loan application was going to, or loan forgiveness application was coming through. So many didn't even act on this. Instead, everyone started using this to set their forgiveness calculators. But you know, true to form, about a month later, June 16th, we get the easy loan application. That is a much simplified way of calculating your forgiveness under your PPP loan. Few things to make sure you're aware of in order to use the easy is, if your lender is having you submit your application on paper using the forms, then understand that the easy is you're only eligible to use the easy if you are a self-employed individual and have no employees, meaning you're a sole proprietor. You didn't reduce any salaries or wages by more than 25% and did not reduce the number of hours. So you're subject to the, quote, safe harbor that we'll talk about with the big application in a moment. And all of the reductions in business activity as a result of the COVID-19 pandemic, you did not reduce salaries by more than 25%. So again, no salary reductions, no FTE reductions, or you are simply self-employed and have no employees. You can, in any of those three circumstances, you can then use the easy application that doesn't go through the FTE calculations, and, you know, where you do reductions for the number of full-time employees, what have you. Just a few, this is mainly for archival purposes. If you're looking, here are the various interim final rules that are linked in the presentation. These were released mostly on May 22nd. But it talked about the forgiveness process and how it's going to occur. Just so you know, as a borrower and lenders as well, here is the timeline for the forgiveness application. As soon as the borrower submits its application for forgiveness, the lender then has 60 days in which to review it. So as a borrower, make sure you understand that it could be up to 60 days that the lender is taking a look at your application, asking you to provide additional documentation to support various things. Or as a lender, make sure you can process them within 60 days. On day 61, the lender must submit its decision. And there are three options, technically four, but we'll talk about that in a second. You can approve it in full, deny it in full, or you can say, we've looked at it and we're going to partially approve it as to this amount. If the SBA, prior to the lender making that determination, has come in and said, we want to review this program, then what the lender does is the lender submits what's called a denial without prejudice, which simply means that a third party is reviewing the loan. The lender is not going to make a determination. And so if you're a borrower and you get a, quote, denial without prejudice, odds are the SBA picked up the loan and is taking a look at it. Somebody wrote in on the last slide, Can a two-person partnership with no employees use the EZ form? If both are owners and self-employed, then yes, you can. If you have any employees outside of owners of the business, then that's when you fall off of the EZ process. Within 30 days after the lender's decision, make sure you're aware of this as a borrower, you can request SBA review if you disagree with what the lender certified. So if you got a partial approval or a denial, you have 30 days in which to escalate it to SBA. And then the SBA has 90 days after that review to then make their determination and submit the forgiveness amount to the lender. We don't really know what the appeal process looks like, but we assume it'll be consistent with the Federal Administrative Procedures Act, where there will be some ability to escalate it up through SBA to evaluate the determination using the federal administrative process, with then later a further ability to escalate it into the court system. A few things when we talk about use of proceeds. There were some nice changes in the Flexibility Act. You've heard us mention this already during this call. Remember, originally we had 8 weeks, 56 days from the date that funds were disbursed in order to use the money. That's since been extended to up to 24 weeks. If you had a loan prior to June 5th, 2020, then you can pick either the 8-week or the 24-week period. Everybody who had a loan after June 5th, 2020 is on the 24-week period. Some nice benefits in the Flexibility Act. The payroll cost requirement was reduced from 75% to 60%, meaning that of the total dollars you submit for forgiveness, only 60% of it has to be for payroll costs. It had been 75%. So you can put up, and so obviously the inverse of that is, up to 40% of your forgiveness application can then be based on mortgage, interest, rent, leases, and utility payments during that time period. So really nice benefit there for borrowers if you weren't aware of that change. Some really nice reductions in the amount that has to go to payroll costs, as well as how you can submit those applications. Quick reference chart for you that talks about these changes in the Flexibility Act. Obviously, we talked about the shift in the forgiveness period, hugely beneficial to borrowers. Interestingly, the safe harbor deadline for replacing headcount, which means if you remember under the original program and under the new program, there are penalties if you cut salaries by more than 25% or you reduce the number of full-time employees. But there was this magic date of June 30th, 2020, and it said if you had replaced those people by June 30th, 2020, and you had restored your full-time employee headcount and salary and wages on that date, you were not subject to the reductions in forgivable amount. The Flexibility Act extends that out to December 31st, 2020, or, and here, good old, regulatory rulemaking, or the date of the forgiveness application, but the date of the forgiveness application only applies explicitly to replacing the headcount. For replacing wages, the way it's written now is December 31st, 2020. We think that'll be cleaned up eventually, but just understand there is an extended deadline to make the safe harbor replacements. And you have until December 31st, 2020, or presumptively the date you submit your forgiveness application. So just like we talked about a few moments ago, when you submit that application and you put it in essence closes the look back window for the safe harbor deadlines. And that way you can say, as of the date I put my application in, I've restored my workforce. Somebody asked earlier, could you potentially go submit a forgiveness application where 100%, particularly using the 24-week period, of the forgivable amount is eaten by payroll costs? Absolutely. 100% of those expenses could be payroll cost, and you would submit no utility, interest, or rent payments on top of it. Given these new enhanced 24-week periods, high likelihood a lot of people will be fully consumed inside of the the payroll process. If you think about how the application worked, it was 10 weeks of payroll. You now get 24 weeks you can submit. So a lot of benefit there. And you can certainly have more payroll than the minimum 60%. However, if you go below the mandated 60%, it's subject to a reduction in the forgivable amount. Payment deferrals, obviously, we talked about earlier. Under the original version of PPP, principal and interest were deferred for 6 months. You now get the 24-week period plus 10 months until your first principal and interest payment is due. Obviously, lots of lenders are struggling with how you're going to let borrowers know about that. Most lenders are doing campaigns to notify borrowers of that change. Some lenders are actually going so far as to do change in terms notices with borrowers. Something really just from a risk standpoint you want to think about as you're kind of going through this process as a lender. Do you want to proactively do that or just simply give borrowers the option? Same thing applies on the maturity date, which is for any loans made after June 5th, 2020, the maturity date is at least 5 years, no more than 10. The maturity date for pre-existing PPPs can be extended at the discretion of the lender and borrower, meaning the lender and the borrower can agree to extend it into the 5 to 10 year period. And so if you're a borrower, you need additional time, make sure you're reaching out to your lender to talk about that. A lot of lenders are just proactively doing a campaign and reaching out to all of their borrowers and saying, we're hereby giving you the right to pay over 5 years. Craig will talk about this later. Remember, those modifications are subject to fair lending concerns. And so if you are going to go out to the world and extend their maturity dates to 5 years or 6 years or 7 years, make sure you're doing it with an eye towards the Reg V, the Equal Credit Opportunity Act, fair lending issues associated with that, so that everyone is given that same opportunity. Then someone did write in with a question about utility payments. Can that be extended to cell phone and internet cost? Yes, there's been guidance that's issued that utilities is broadly read. It also interestingly picks up fuel costs as well, like if you have company-owned cars and whatnot. Utilities are one of the things that's been very broadly read, and you would actually want to get copies of the reimbursements for those amounts. And then, similarly, it's very similar, I think, to how you would talk about that with your CPA, which is just simply the fact that an employee paid a cell phone bill is likely not enough documentation that that was a business expense for utilities. And so that's definitely something to talk to your CPA or tax attorney about to make sure you're following the IRS guidelines for what counts as, properly reimbursable employee expenses, so that it clearly becomes an obligation of the company and it's not, for someone to, surf YouTube for 6 hours a day. Briefly, we'll put this up on the website, eligible payroll costs. This is just a quick summary of what's able to be claimed as eligible payroll costs. The most important one is the bottom right corner, which is obviously with the extension to 24 weeks from 8 weeks. The maximum per employee amount that you can claim is now $46,153, which is $100,000 divided by 52 weeks multiplied by the 24-week period. We'll talk in a moment. There was one huge takeaway if you are a sub S filer, meaning pass-through disregarded tax entities with an LLC, or you are an owner employee, meaning you own the business. You do not get the benefit of the 24-week period. You are stuck with the original 8-week period. And so we'll talk about that here in a minute. A few remaining obstacles to forgiveness that are living out there, things to be aware of. Remember, any reduction to FTEs is really penalized. Any reduction in pay by more than 25% is subject to a significant penalty. And understand the default is an expense has to be both paid and incurred during the 24-week period, although there has been some relaxing in the Flexibility Act. We'll have that on the notes on the website, where, for instance, if a utility bill was for services during the covered period, but it's paid in the next utility bill cycle, that's now eligible. And similarly with payroll, if you're on a 2-week or less payroll cycle, you can actually realign either your 8-week or 24-week period to align with your payroll cycle. Someone did write in and ask, if you do use less than a 24-week period, would you cap pay accordingly, meaning instead of going to the 48,000 number? Yes, you're exactly right. There was actually an FAQ that was issued on that. If for some reason you're using less than a 24-week period, the total payroll caps are not the 24-week payroll caps. So it is reduced in proportion to the portion that you're claiming in your forgiveness application. So you can't pay someone $48,000 in 1 week and then say that's my 24-week period. Instead, it's designed to adapt to the period used in the forgiveness application. As we noted earlier, just understand, anytime you use less than 60% for payroll costs, you're going to be subject to the reduction. Although interestingly, when we talk in a moment about FTE reductions and employee pay reductions, it is not double counted, meaning you don't get both an FTE reduction and a reduction in salary. If the employee is already counted in the FTE, full-time employee reduction, you're not also penalized when they're counted on the salary reduction. A few more notes on paid and incurred. Obviously, if you're on the cusp with that, make sure you're talking with your accountant or your tax attorney. The default rule is both paid and incurred, but for certain classes through the FAQs, they have relaxed those rules. As I say, the most meaningful for most folks' purposes is payroll can shift if you're on a 2-week or shorter payroll, and utility expenses can shift, or mortgage expenses can shift if for some reason you pay off cycle, meaning the obligation was incurred during the covered period. Hopefully most of this goes away with the 24-week extension. That's certainly been the feedback from our lenders as well as our borrower clients, is a lot of these really crazy side cases are being done away with because of the benefits of the 24-week period. Somebody asked a question, we'll talk about this in a minute. If you're under the self-employed borrower exemption, do utilities still tack on top of the 15,385 number? Yes, you can still count utilities subject to the cap that they can't be more than 40% of the submitted amount. There's been some restrictions on payroll payments that have been eased. Obviously, we talked about the issue with the payroll shift, and interestingly, in payroll costs for furloughed employees, bonuses, hazard pay, all now eligible for forgiveness. They've clarified that. Even if employees are not working, but you're still paying them, this is what we saw with a lot of the movie theaters, sports venues, restaurants, all of those costs are still eligible as well. And then if you pay by ACH as opposed to by paycheck, the time when a payroll cost is, quote, incurred and paid is the date either that you originate the ACH transaction or you distribute the paychecks to the employees. So it clarified some of those questions about ACH distribution. SBA continues to try to give some leniency to borrowers who had to lay off employees for other reasons. The IFR, the interim final rule that was released in June, did broaden this, and there is now safe harbor protection if you had to fire an employee for cause, if an employee voluntarily resigned or voluntarily requested a reduced schedule. Now, if you do that, you need to make sure you're keeping very good records of that. Similarly, if you offered to rehire an employee and he or she refused to take that offer, make sure you're documenting that as well, because it doesn't count against you in the calculations. Interestingly, in the revised IFR, they have written in an obligation to notify the unemployment commission of your state that you offered to rehire that employee and he or she chose not to do so. And so make sure you're documenting where you provided that information to the unemployment insurance or unemployment security office of your state, because that's now one of the requirements under the revised interim final rules. But we did clarify that if you do have to let someone go for a cause, we had people who retired during the COVID pandemic period. All of that does not count against you for PPP purposes. This is more for everybody's reference. Make sure as you're doing the calculations that you're looking at both the simplified and average full-time employee calculations. We ran this hypothetical for our clients. Just make sure you understand you need to look at it both ways because potentially one is better than the other. Under the simplified method, full-time employees get a 1, everybody else gets a 0.5. Under the average FTE calculation, you actually carve it up so that you look at the average hours worked compared to 40 and you assign them a relative percentage. Usually one is better than the other. One thing to be aware of is you can't shift back and forth. Once you pick one of these lanes in your forgiveness application, you have to stay in that lane. And so you couldn't use average FTE on one portion. And then when you're looking at the rehire calculation, use the simplified method. Whichever one you pick, you got to stay with it. A few notes for independent contractors, sole proprietors. Obviously we talked earlier. First thing, the $100,000 annual limit on compensation applies. It's subject to $20,833 cap, which is 2.5 months of 12 months. So make sure you're not exceeding that overall cap. They also clarified that your 2019 compensation, prorated by the number of months you worked, also serves as a cap, which means if you were an owner employee, you only worked 6 months in 2019, you would have to prorate out your payroll over those 6 months. And then that now serves as your cap when doing these calculations. So there's potential impact if you had owner employees not working the full year in 2019. Non-owner employees, even if you have owner employees within the mix, not subject to this cap, they get the normal employee 46,154 cap in the 24-week period. It's just owner employees that did not get the benefit of the 24 weeks. You're still subject to the aggregate cap. The rationale for that, in case anybody wonders, is what SBA said is because of the way they calculate the amount of PPP you're eligible for. They did not want a sole proprietor who also had employees to increase their own paycheck at the expense of employees. So instead, all of the benefits accrue for non-owner employees. Non-owner employees, not defined anywhere in federal law. We've taken it to mean that it is any ownership interest in the company itself. It could be as low as 0.0001%. And potentially, because this isn't defined, you may have to treat that as an owner employee. A lot of people have kind of theorized you could actually divest yourself of ownership of the company and exclude and take yourself out of this exclusion. We've seen people doing that. It appears to follow the letter of the regulation. Obviously, we'd advise you before you do that, make sure you're talking to your CPA or your tax lawyers about that, because there's obviously risk inherent in divesting yourself of ownership of the company. Similarly, for S corporations, those that are paid on a pass-through basis, group health insurance costs no longer eligible. You don't get to add that on like you do for a normal employee. And part of that is because in your W-2 as a S corp, health insurance premiums are actually listed as part of your compensation. So the idea is you don't double count it. It's not both compensation and also subject to the unlimited cap for group health insurance benefits. Similarly, retirement costs for S corporation owners are eligible. However, there's this note in the EZ, and I'll tell you, tax lawyers are having a heyday with this. This isn't in the full application. It's only in the EZ application. And so take that for what you will. Some people have said they just forgot it in the application and they'll change it eventually. Others have said this only disqualifies you from the EZ application. The conservative approach, obviously, that we always advocate is you treat this as a just true in both circumstances, which is contributions on behalf of an owner employer are capped at 2.5 months worth of the 29 contribution, meaning you could not pay all of the owner employees, self-employed individual or general partners retirement benefits in the forgiveness period, and in essence advance 12 months of costs into that 1 month. It'd be subject to the 2.5 month cap based on your 2019 data. Again, something to talk to if you want to try to run that model. We talked earlier, there's no double reductions. If someone's counted in the FTE reduction, they're not also counted in the salary reduction. So that's fairly clear in the application, but just something to be aware of. If you're concerned about it double hitting you, make sure as you're preparing your forgiveness application, you're exactly following the letter, and understand the intent is not to have you double penalized as you're doing it. As we talked about earlier, lot broadening of rent and mortgage, definition of what are utilities. As we saw earlier, the forgiveness application actually clarifies that telephone and internet access, as long as service is pre-February 15th, 2020, eligible and the definition of utilities. More here just for your reference in the future. And there are some ways to advance payments, meaning, for instance, with mortgage interest, you cannot advance mortgage interest. Specific provision of the interim final rule, you can't pay that in advance. Mortgage principal obviously never could be advanced. You only can pay interest on a mortgage. Principal does not get forgiven, and certain non-payroll costs are eligible as long as they were paid during the cover period or incurred. So we talked a little bit about that earlier. One thing that is interesting, everybody asks this question, can you use PPP funds for non-PPP purposes and simply forgo forgiveness? I will tell you there is no guidance specifically on that, but in the application, the borrower has to certify that the borrower understands that if funds were knowingly used for unauthorized purposes, the federal government may pursue recovery. So just understand that there is some language the feds could point to in the event that does occur. You may have to address it. Somebody did ask, can you pay rent in advance? No, but there is a mechanism for if the rent is accrued during the forgiveness period and simply paid off cycle. So you can't advance the full year of rent to get it in the forgiveness period, but in the event that you pay it off cycle, there are mechanisms to protect you there. Talked earlier about the correction period. Obviously, it's been extended to December 31st, so that should help a lot of people, or the date you apply for forgiveness. So if you didn't restore your salary and wages by June 30th of 2020, there is still time to correct it and suffer no penalties in a reduction of your PPP forgiveness amount. Tax treatment still up in the air. Obviously, the IRS took the position that any expenses that are forgiven under the PPP cannot also be counted as Section 162 or 163 expenses, which are trade or business expenses or non-taxable interest expenses. Congress continuously trying to fix this. One thing to talk about, if this is a big problem for you, where you'd be giving up significant benefits, talk to your CPA or your tax attorney. There are many tax lawyers who are kind of theorizing that there may be a mechanism where you could take a deduction in 2020, process forgiveness in 2021, and there may be certain benefits under the tax code. Full disclosure, neither Craig nor I are tax lawyers. We would never profess to give you advice on tax issues. We are bank regulatory attorneys. But that being said, something to talk about and explore, because there are lots and lots and lots of very smart tax lawyers who are thinking about this issue and ways potentially you could avoid having to give up both of those tax benefits. Also, remember, under the revised interim final rules, you may have to provide documentation of your payroll. So make sure you're keeping very good records there. Obviously, given the importance of full-time employees, you want to keep very detailed payroll records and work records. And then in any circumstance you're going to claim utilities, make sure you're keeping records of exactly who you paid, when it was paid, and when it was accrued. We've seen some people having trouble with accrued, something to talk to your CPA or tax lawyer about, but many of the utility companies are realizing this is an issue and are helping provide documentation to PPP borrowers. So if you're looking at something like, your electricity bill, they can actually break it out so that you can see what accrued during the period and what didn't, meaning it almost on a daily basis, as opposed to just the monthly basis. SBA can basically review anything, but this is what they specifically carve out. Things to be aware of as a lender or borrower is compliance with any provisions of the CARES Act. We'll talk about that from a lender perspective. compliance with the loan application, any SBA rules and guidance. SBA did clarify you are subject only to the rules that existed at the time you applied for forgiveness or at the time that you made application. So in the event they change the rules going forward, you're only held to the standard of what was out in existence at the time you took that action. We all think that probably makes sense. To be determined how that's going to work in practice. Shift over to Craig. He's going to talk a little bit about lender concerns here.
Thanks, Brad. So as Brad was bringing up, the loan modifications are going to pose a particular challenge from a regulatory perspective. As you see here, lenders have the option to extend existing loan maturity periods from 2 to 5 years. It's done through mutual consent, and all loans after June 5th, 2020 have a minimum maturity of 5 years. You're going to have to be very specific about how you approach this to avoid any fair lending issues or concerns. You're going to have to ask yourself how are you going to roll out the modifications? Are you making borrowers aware through a mailing? Are you only informing them if they call in, if they originated prior to June 5th? And then how are you treating that population that originated prior to June 5th? Are you automatically extending them? Are you giving the choice to extend them? Are you sending them new documentation? Any time that you're rolling a product out like this and there's a change in terms, you don't want to have two different populations with a disparate outcome. You're going to want to be well aware and document how you thought through that process. So if challenged by a regulator over your next exam, you can trot out how this was presented either in a committee or a working group, or that you thought about the fair lending concerns about the change in terms. Next slide, Brad. We also want to point out here that, for the last couple of weeks in the Trenches series, Brad and I have been, just keeping it on everybody's radar that there's going to be a tonal shift in public sentiment as well as the regulatory supervision of any activity that's done during the pandemic. And what I wanted to point out here is we're already starting to see that tonal shift within PPP. When it was first rolled out, it was touted as a needed tool to triage the pandemic, inject needed funds into the population through the only means that the Treasury really had necessary, which would be going through banks as a conduit. You're starting to see that shift in the media and in public sentiment for the PPP now being viewed as a way that banks could generate fees and undeserved companies receive a lifeline from the Treasury and the SBA, which we believe is going to signal the anticipated shift of how the regulator is going to view your activity over the next 12 months or 24 months, whenever they come in next. We posted here some articles from the last 2 days. CNBC pointed out on the 7th that, it's billionaires, country clubs, private jet companies, and Kanye West are those who are receiving millions in funding through the Paycheck Protection Program. Wall Street Journal on the same day said banks could get over $24 billion in fees alone from PPP loans, not actually borrowing, but through the actual processing of the loan. They went on to point out JP Morgan Chase, Bank of America, just the two of them are in line to split between 1.5 and 2.6 billion in fees. Then American Banker this morning pointed out that Wells and other large banking companies, JP Morgan Chase, Bank of America, Citigroup, have all said that they're going to give away the processing fees generated by their PPP activity after critics complained about lenders profiting from the rescue program. I kind of look at that as more of a defensive stance, saying that, look, when the regulators come in, we know or we anticipate, or the larger banks are anticipating already, that, look, this is going to be a point of scrutiny, that it's going to shift just like it did in 2010, 2011, and we're going to be viewed as, profiteering off this program, so we want to kind of get ahead of that narrative. Wells Fargo today announced a program where they're going to donate $400 million in fees to an Open for Business fund that'll be operated under the holding company that will work with nonprofits across the country to provide capital and assistance aimed at small businesses, but especially minority-owned small businesses. We point that out because I like to look at the global banks just to see what their temperature is for the regulatory landscape and how they're viewing the changes that they anticipate coming. And obviously, Wells Fargo is looking to maximize their CRA credit and how they can shift the narrative now. I just think that's something we should be thinking about for whatever size lender you are. just be well aware that the regulatory landscape is going to shift along with the reputational risks that are shifting now in the media. Next slide, Brad. So we have this here for future PPP litigation regulatory actions. On the regulatory side, it's quite obvious that you're going to see fair lending or COA Reg B violations issued by the regulators in the application processing, as well as the forgiveness processing. We've already seen significant agent fee cases come out of private litigation and class actions. And also False Claims Act violations coming from the DOJ and regulators themselves. We do, Brad, you want to address what the Treasury Secretary said around the agent fees?
Yeah, interestingly, during testimony before the House, it was specifically brought up, asked of Secretary Mnuchin about agent fees and whether or not banks were required to pay agent fees as part of the program. And Secretary Mnuchin, during that conversation, said no, that it was only designed to deal with those circumstances where the bank and an agent enter into a contract and protect those folks. So kind of a blow to the PPP agent fee cases if you're on the side of the agents. Good news if you're on the side of the lenders. And Mnuchin also said that they are looking at issuing further guidance to further clarify that. And so everybody's on the lookout for what ultimately SBA is going to take in terms of position. So that was, a whole string of lawsuits where CPAs and other brokers and whatnot are going in and demanding that banks pay certain fees associated with those applications.
And for those cases, although we're expecting it to be mitigated by the Secretary's comments, we don't believe that the plaintiff's attorneys will, back off anytime soon, especially without that guidance being issued. But that should kind of be one thing that you're building into your complaint program. You should have guidance out there internally in your institution that are escalating any complaints around the PPP program, so you can see those agent fee cases before they start. They'll typically come in a form letter from a complainant that says, you owe them agent fees. It's a standardized letter, but you'll see that if it's not escalated up, you can't get ahead of it. You want to see those complaints in your legal departments, in your compliance departments, so you can kind of navigate and position yourselves to get ahead of the problem. Because about a week or two after you start to see those complaints, you'll start to see a summons complaint from the plaintiff's attorneys' firms. Next slide, Brad. We also want to just address, what we're seeing from regulatory risk, or what we're anticipating as regulatory risk that you're going to see, grow exponentially in the coming months. The speed at which the program was rolled out, the magnitude of its evolution are creating, regulatory challenges across the board that you're going to see in your exams, you're guaranteed to see in your exams in the next 12, 24 months. You're going to start to see UDAP questions. There's limited guidance out there, so how are you answering the questions posed by borrowers? Were the people that were taking the applications or the channel that the applications were being processed through, were they informed as to what the offerings were, how forgiveness is working, how originations are working, how did you market the product itself? Did you give it to a population of loans or a population of current borrowers? Did you go wide and go anywhere in your footprint? Did you go even wider and go national? And if you did any of that, how did you discuss that internally from a safety and soundness perspective? Also, did you deploy any FAQs or waterfalls within the bank for those working at the loan level to implement best practices? Was there any training there? Are you documenting your process and procedures around the marketing, originations, and now forgiveness? We've said this before in previous PPP webinars, but we want to make sure that everyone is documenting their approach to this program today and is not going to wait to rebuild their programs when they're asked by a regulator. You don't want the program living in your emails and living on conference calls between your actual employees. You want it documented, and you want to be able to reproduce it very quickly for a regulator a year from now. That would include any BSA, AML, KYC program that you had for your bank and how that applied or impacted the PPP program. Was it run in tandem? Did you have all those same controls duplicated and applicable to the PPP lifecycle? The complaint program, we mentioned earlier that you want to see those agency cases. Are you escalating any ACOA or fair lending allegations within the PPP? Are you aware of those as an institution as a whole? The regulator is going to look for that, not only as they look for it in your regular CMS, but also how you applied it particularly to this program. Next slide, Brent. Here we just want to outline again what we've seen in the last couple of weeks. We've seen a CFPB blog post by Patricia Flickman, the head of fair lending, and the SBA executives, stating out there that there's ACOA applies to this PPP program and any lending under the CARES Act. And basically within that post, they were, soliciting potential borrowers to file complaints. And when the CFPB is doing that, we're expecting them to look for those complaints in their future exams. We have an OCC Bulletin 2020-45, which addressed the program itself and how it weighs on your safety and soundness. Were there discussions around why you're lending to the population you're lending, how the process works, if you're going to document it, what the procedures are. You want to specifically look at that guidance from the OCC and make sure that you conform to it. Then we also saw another FAQ from the CFPB a couple weeks later around ACOA, again, showing that ACOA is going to be applied very consistently to any COVID-19 related lending, specifically this PPP program. Then we want to mention Wells Fargo and B of A. They've already mentioned within their 10Ks that they've seen regulatory inquiries, routine and non-routine, around the PPP program. Once you're starting to see that in May at that size banks, you're going to start to see it, shortly within institutions in the middle markets, those under 100 billion, operating from anywhere from $1 billion to 100 billion in assets. You're going to start to see those questions roll in from the regulators. Next slide, Brad. This is a flow chart that Brad put together this morning, kind of showing you how you can get ahead and prep for your upcoming exam. If you look at that first box there, you want to document, even if retroactively, your policies and procedures related to the Paycheck Protection Program. Don't take the stance all the way from the top, from the board perspective on down, that the program is over because originations are slowing and coming to a close. That's just the beginning of the product life cycle. You still have servicing, forgiveness. You're going to have these issues at least for the next year or possibly 2, 3, 4 years, depending on how the borrowers acted within the servicing of the loan. But you're going to want to go back and document what you did. If you made a mistake, fine. Address the mistake and kind of start to craft the narrative around the speed of which the program rolled out. And also the evolving guidance. We mentioned that a couple of slides previously, but the guidance that came out in April and early May is very different from the guidance that's out there in late May, June, and now July. You kind of want to have in this documentation, when said guidance was released, when it was digested by your institution, and how it was applied. It'll go a long way when you're speaking to the regulators of what potential risks were out there to consumers or the bank itself. If you can show that the CMS was, taking in the guidance that was coming out and applying it on a go-forward basis, that you were addressing and catching the risks that were out there, you can start to craft that narrative towards, hey, look, we were helping the country in a national emergency. We were called to action by the Treasury. We did so. And we did the best we could with the speed of which the guidance was coming out towards us. What you don't want to be doing is allowing yourself to be caught flat-footed in June of 2021 if someone's in there asking, well, what happened here? And if it was governed by guidance that came out 2 weeks after the loan that the regulators are now questioning originated. You want to have that timeline there and kind of walk the regulator through the bank's thought process and the bank's risk analysis of the program in real time as it occurred, as it's occurring today, and kind of get that examiner, the EIC, prepped for how it worked in your bank without them having to ask multiple questions and form their own opinion. Next slide, Brent. And that's it.
We'll try to grab a few of these questions that have been sent in. So one person asked, what happens if a borrower obtained an EDL disaster grant, in essence, after they received their PPP funding? If you look in the questions associated with the or rather it's the instruction sheet associated with the forgiveness applications. What it notes is that the SBA will reduce the forgiveness amount by the amount of those EDL disbursements. And so you need to make sure that if a borrower did receive one of those grants, one of those emergency grants, that they are properly referencing their EIDL or EDL loan number on the first page of that application, because SBA is going to match it up and then reduce it accordingly based on the amount of that EDL grant that was dispersed. Also, somebody had asked earlier, is it possible that because of the new 24-week period, you potentially have payroll expenses that will well exceed the amount of your PPP loan? And is that effectively a way to get past some of the reductions associated with FTE or salary reductions? If you actually look at the flow in the forgiveness application, right before you do the reduction in salary or the reductions for FTE reductions and salary reductions, it makes you take the greatest of those numbers, meaning the payroll expenses, the payroll reduced plus utility, or the PPP loan amount itself. And so there's certainly some benefit of having additional payroll costs to quote spare in that calculation, but where the reduction occurs actually comes after you take the greatest of those numbers. So it's not exactly a workaround, I should say. Similarly, even if you are using the 24-week period, the FTE reduction and salary reduction calculations are agnostic to your forgiveness period. Instead, it just simply asks the question, did you reduce any salaries by greater than 25%? Did you have FTE reductions? And then the only way to have none of that reduction is to do the comparison between the pre-COVID FTE numbers, pre-COVID salaries, versus the safe harbor date. You know, that was June 30th, it's now December 31st, or the date that you submit your PPP forgiveness application. We've covered a huge quantity of material today. We appreciate everybody. We're going to stay on and continue answering some questions, but that'll conclude the formal part of the webinar today. Look forward to speaking with you next week. We're focusing again on the lender side next week, specifically looking at the CFPB's upcoming 2021 agenda and where we see the regulators going as we look forward in our crystal balls to the next January 1st, 2021, when hopefully we will not be speaking of COVID anymore, and instead talking about what regulators are going to be looking at as they start to examine various lenders. So with that, thanks so much, everybody. We're going to keep answering some questions that have been shot in. If you do have questions, feel free to raise them. We'll stay on here for a while answering these. Someone asked, if you return your EDL advance, should you still reference the EDL number on the forgiveness application? Something to discuss with your lender, but out of abundance of caution, because the question itself asks, did you receive an EDL advance? I would actually reference it, put the EDL application number and the advance amount in the forgiveness application, and then note the date it was returned if you did repay that EDL advance previously and you're not using it as a basis for your forgiveness. So make sure that the lender or SBA, if they come back, knows that. I'd actually note that on the forgiveness application or in comments to the lender if the lender is using one of the automated platforms. But I would not risk not putting it on there where there's some sort of mismatch within the SBA database. And again, that's just plain conservative. You don't want to potentially trigger SBA doing an audit because for some, they show you as having an EDL and you did not disclose the EDL application number on the forgiveness application. Additional questions that were sent in. Does the covered period formally end at the time of application if you apply ahead of time? Yes, all of your expenses are then locked as of the date of your forgiveness. You can, in essence, do an open forgiveness period where you submit and then supplement it, what have you. Instead, it is a locked point in time. And then, as we noted, if you are using for instance, the payroll caps where you potentially would hit the $100,000 annualized payroll cap, that is then reduced for the period in which you're applying. So if you're using a 18-week period to apply, you would then, if this were the case and you were potentially bumping up against the $100,000 annualized salary, you'd have to then look at that over an 18-week period as opposed to the full 24-week period. Someone asks on the line 6 versus line 9, someone says line 6 adds the eligible cost and then it's multiplied by line 7 to answer line 8. If everyone is following along on your application, line 6 is where you total your payroll and non-payroll costs. That occurs after, and then you subtract the reduction in line 5. So this person asked, do you think it'd be possible to outspend your loan, multiply by the reduction quotient, and then on line 8 still come up with an amount equal to or higher than the original amount because you spent so much during the 24-week period? Yes, it appears possible on the application that following exactly the instructions, you potentially could have so many payroll costs and expenses that you potentially could do it. AICPA, I think, which is one of the big CPA organizations, had noted that potential flaw, and we'll try to circulate some information. Whoever sent that one in, if you'll reach out to me directly, I'll send it in because we think that might be a loophole that's going to be closed eventually. And so if you would just email either me or Craig, we'll be happy to talk to you offline about what we've been seeing. Because you're right. I think by the calculation you could have that happen, but I think it is subject to potentially having that loophole closed. Hopefully we got to everybody's questions. Thanks so much. We appreciate when this is interactive and we're able to field some of your questions. We appreciate you participating today. And for those of you on the lender side of the shop, we look forward to talking with you next Thursday as we dive into regulatory agenda for 2021. I want to thank my colleague, Craig Nazzaro, my partner in crime in so many of these presentations, for his participation today. And should you have questions, feel free to reach out to any of the Nelson Mullins team offline. We're always happy to help. With that, thanks everybody so much for your participation.
Thanks, guys.